Good afternoon, financial professionals. I'm Dan Peterson, president of E4 Insurance Services, welcoming you to The Brew, building relationships every week. Thank you for tuning in today, and for those of you joining The Brew for the first time, welcome. We'd like to start the Brewcast by celebrating today's National Day for February 23rd. Today is National Banana Bread Day. Let those bananas get brown and put them in a great banana bread. It's also National Dog Biscuit Day, so make sure you give your special pet a treat when you get home, and treat yourself and your dogs today. Banana bread and dog biscuits. Today on The Brew, as part of our product solutions series, we're pleased to have Dale Humphrey, president of Northstar Funding Partners. He specializes in strategies for the ultra wealthy. He's been in premium finance and structured financing solutions involving insurance since 1989. He's president of Northstar Funding Partners, and Northstar is the leading provider of finance solutions, and we're happy to partner with them. We recently had a very nice, successful financing case that was part of an estate planning and Dale and his team at Northstar Funding were great to work with, and advisors that were involved with this really appreciated all the support that they brought. So feel free to share in the chat box any questions or thoughts. We'll open up for questions at the end. Thank you for tuning in, and without further ado, Dale, welcome. The mic is yours.
Thank you. This is not as exciting as banana bread, but we're going to do our best here. As indicated, this presentation, I was telling Dan and the others that this normally takes well over an hour for me to do. I've kind of cut it down. I'm going to move through these topics fairly quickly. I understand there might be a whole span of understanding of this topic, so I've got to be a little bit guarded. I don't want to throw too much detail to you, but we are going to move at a fairly good clip. As we indicated, we're talking about premium finance, or more specifically, financing life insurance policies. This has existed for some time. I would say that it probably has not gained a high degree of traction until probably the early 2000s or so. And it's gone through a number of different phases to the way these loans have been built out, and this industry has kind of managed itself over time. I would say its reputation is still, to some extent, a little tarnished. There's been a lot of shenanigans in this industry, but today we do operate in what I'd fairly straightforward world, as I call it. The one thing I want to point out about this type of financing, it's unique in one particular way, and that is we are going to utilize the policy's cash surrender value as a form of collateral. A question we get a lot of times from retail-based people when we do speak to them, in addition to the advisors, is, why can't I go down to my local bank and get this loan? And my comment is, you could go down and talk to your bank about lending you money to pay these premiums. However, the distinguishing line then, of course, is that you've got to collateralize this loan. And that's a key point, and something that will run the course of this presentation, is these loans are secured at all times, meaning they must be collateralized at all times. And the front line or primary basis of collateral over time is the policy cash value. So I say to those people, that's fine. You can ask them if they'll finance the premiums for you, but then you ask them if you get at least a 90 to 95 to 100% offset on your collateral using the policy's acceptable cash surrender value. That banker or person at the bank is going to look at you a little cockeyed. They're not going to understand what you're saying, and maybe when they do go back and investigate it, we'll come back and say, no, we can't do that. That's why in the industry we operate with today, we've got roughly 25 to 28 active debt providers. And those debt providers range from the world's largest banks to what we call monoline specialty lenders. And when we refer to monoline or specialty lenders, where we tend to put our focus on, those are organizations that do not do auto loans, credit cards, mortgage, anything like that. I mean, they do only life financing. And as I indicated, the cash surrender value is a primary basis of collateral. And for that reason, about 80% or so of the total premium that's financed in a given calendar year is probably going to be IUL, or Index Universal Life Insurance, and the other portion will be whole life. Again, you're talking about accumulation products, permanent life insurance products. Now, one of the things that's misunderstood about financing is that it can only be utilized and applied in certain situations, like, for example, estate planning or other fairly narrow sources. That's not accurate. Financing can be applied pretty much in any setting that you're going to utilize life insurance. We use it all the way from typical ILET-based transactions all the way to very large corporate transactions where you're financing groups and things like that. So the key point is that you're not restricted in terms of dealing with planning objectives and scenarios for your clientele when applying the debt. There are several themes that I'm going to talk about. This is a core one. Most of the loans that are made in this industry segment, they are not made to name people. That is, they are not personal loans. There is some portion of industry that is personal loans, but the vast majority of our industry is focused on lending to some entity. And that entity is normally defined by the planning scenario. So we'll go back to a fairly simplistic situation. Let's say we have an estate planning case. The folks that want to enter this transaction have gone to their legal counsel. They've established an irrevocable life insurance trust, and they've gone through the steps of procuring financing for the transaction. So in that instance, that borrowing situs is defined by that trust. We will engineer the loan to be made to that trust. The policy will be owned by that trust. That'll define the loan structure. We also can pivot ourselves into different forms of trust, revocable, living trust, etc. We can also go into the commercial landscape. And if I turn the clock back when I originally started in this industry, probably about 80% of the deals that I was involved in were all ILET-based, pure estate planning. Today, probably about 70% of the transactions that my operation's involved with are commercial type deals. So those are going to involve special purpose LLCs, corporations, S Corps, C Corps, special purpose entities that are established just for the purposes of the transaction. And also, the bias has shifted from a pure DB sale to an accumulation sale. That is, the products being utilized for purposes other than pure death. Because again, with you folks in the industry, I mean, we're trying to tilt the scale a little bit in terms of the orientation of these products. The product sets today should not be positioned as pure life-driven vehicles. They have so many other features, so many other attributes, and accumulation one of them, that can be used for retirement, supplemental retirement, and other non-qualified deferred compensation, a variety of things that are not going to just focus on the death of the insured. The loan structure is so important because it defines the path of the transaction. So when we talk about building these deals out, we want to understand the loan structure because it'll define the underwriting going forward. Now, as Dan indicated, we do work primarily in the high net worth segment. I mean, the majority of the transactions on a pure scale basis are going to be directed towards fairly large premium sales. Our average funded premium over the tenure of this company, which is in excess of 25 years, is about $900,000 on a 10-pay non-MEXL, extremely large cases. Around 2005 and 2006, the life insurance companies started to ring fence this industry. What I mean by that is they basically had to find a way to police the transactions. They were concerned about the way financing was positioned, being sold. They didn't quite understand what was coming into the company to be issued, supporting these transactions. And so they kind of coalesced around these requirements. So in the environment we operate today, we have very specific guidelines with the carrier set. And they normally have taken a team of people or a single person and bolted into their advanced markets team. And that person is responsible for vetting these transactions. And part of that vetting process is to understand more carefully who is entering the transaction. What is the profile of the insured, which most of the time is also the guarantor for the transaction. And so as a common thread that runs across the industry is a minimum $5 million verifiable net worth. I would say the average verified net worth that we work with is in about $12 million or so, but $5 million is kind of the stated minimum. Some carriers are at 10, but again, $5 million is kind of the key understanding. Now, the other component too that they're focused on is the balance sheet. We're focused on the balance sheet too. What does that mean? We want to try to do the best job we can on the front end to take some assurance that this person entering this transaction can support it over time. What does the balance sheet tells us? It tells us asset composition. It tells us the track of the net worth. It also will indicate or provide some degree of outlook into the future of their ability to collateralize the loan. We'll talk a little bit more about that. Now, large cases are great. They are exciting. It's what I spend the vast majority of my time doing, but they're also heavy lifting. These cases take time. I would say that people always say to me, well, how long will these things take? I said, I've done one in three weeks. It's been more or less delivered on a silver platter. And then I just got done with another deal last week, which took 3.5 years. Now, again, there's a variety of factors that influence that. More realistically, plan for 2 to 3 months if you're really on the ball with the way these things are going to track. But the main point of this is not to push you away from large case financing, but you have to understand these are difficult cases. You've got a variety of components that have to be put together in addition to the base level underwriting for the policy itself. I try to describe it as an evolving fact pattern. We have to build a fact pattern over time. It's going to have a lot of deliverables. So in some ways, and I don't want to diminish the importance of it, these cases are basically a glorified photocopying exercise. Tax returns, personal financial statements. We need the structuring elements, the entities, et cetera, et cetera, et cetera. So we're gathering all of this information. And also, when the scale of the transaction increases, the relative number of people involved increases as well. So you just don't have the writing agent, you have other advisors, attorneys, tax counsel, et cetera, which, by the way, is a good thing. We do not ever advise a writing agent to go into any of these transactions solo. You must have assistance from these other professionals. Now, the biggest issue that we face with the larger transactions at the outset, plus also over time, is the thing called gap collateral. I'm not going to spend a lot of time on this, but as I talked about earlier, the primary basis of collateral for these transactions is the policy's cash surrender value. Now, in these bigger deals, you're going to have this other element called gap collateral, which is roughly the difference between the cash surrender value and the loan balance. For most transactions, the cash surrender value is going to be less than the loan balance. As I indicated earlier as well, the loan must be secured. It must be collateralized at all times. So you have to bring to the lender a pre-vetted, acceptable form of gap collateral, cash equivalents, diversified brokerage accounts, asset-backed letters of credit. Now, the reason why that's so important is that these transactions either work really well or they go sideways based on the management of gap collateral. We're talking about something that's going to extend well beyond 10 years, something that's going to be checked on annually. So again, if you enter a stressor point in these transactions, the big ones, it'll be due to gap collateral. Now, also, despite what people will tell you, every single financing transaction has a degree of risk. It's how we manage that risk. It's how we define it at the front end that'll change the track of the transaction. So I don't want, again, I don't want to spend a lot of time in large case markets, really not the focus of this, but I do want to set up the way we're going to discuss this other loan arrangement. So I'm going to escape out of this because I've got to get this thing blown up for you here. So this I'm just going to use as an example real quickly for you. This is not a huge deal, but it qualifies a large case. Large case in my book, the minimum premium is about $200,000. When we go below $200,000 in the financing space, the economics start to move against people. What do I mean by that? The pricing in this industry, and when I mean pricing, I'm talking about the interest rate charged for the loan. The pricing is determined by the premium solve, which of course is going to define the size of the loan. The smaller cases actually get somewhat penalized because most debt providers are going to charge higher interest rate spreads on the smaller premium deployments versus the larger ones. So this is not a huge case, but certainly a very healthy case. And so I just want to go through this real quickly because I got to just position with this other loan that we're going to talk about. 10-pay non-max solve. We do not do 5 pays. We do not do 3 pays, which are insane, or 7 pays. Our stance is a 10-pay solve provides a greater degree of safety and a buffer the way these transactions are supposed to operate. You're better off getting more cash in the contract than less. Does not mean or indicate this person has to go 10 years out, but I'd say when you get to beyond the corridor or something like that, and you want to discontinue the premium scale or change it, you can do that. But from a due diligence perspective, we'll set it up on a 10-pay. This is the other very important thing right here. This is the contribution in this sample that the individual entering the transaction would contribute towards a loan. So this is basically writing a check for $60,000 to support some combination of interest and principal balance of the loan. This is so important because this defines the scale of leverage for the transaction. Leverage is the concept that you're paying a smaller amount for a certain outcome. And this amount also defines the level of risk for the transaction. This is running about 20%. So this out-of-pocket's about 20% of the premium sell. To me, that's an effective leverage range. That and maybe a little bit higher. When you start to decrease the out-of-pocket, let's say we make it 10,000, that would be increasing leverage. And by definition, you're going to increase the level of risk of the transaction. This is the one area in these deals that the individual entering the transaction can define and control. The two other variables that they're not going to be able to control will be the path of interest rates and the performance of the policy over time. But this, by the way, is the risk control that they do have the capability to manage over time. Now, the other important concept here before I go off the big cases, here's our gap collateral. So this is our map or estimate of how much additional collateral this particular guarantor would have to use to have available to support the transaction. So again, this is in addition to the policy CSV. This is in addition to the policy CSV. This is what they're going to have to be able to meet over year. Now, I will point out, this is our proprietary method to estimate this number. It's not intended to be a guarantee or a set number. This will change. It'll change based on the dynamics of the out-of-pocket, the relative performance of the policy, and also the behavior of interest rates over time. Now, the out-of-pocket and the collateral, the gap collateral, opt like a teeter-totter. If we lower the out-of-pocket, increase leverage, we're going to see gap collateral go up on a relative basis. So these are just real quick. I just wanted to show this because this is the snapshot just of a large case. Again, the variables that we're contending with is we have a verifiable net worth individual, we have a suitable borrowing vehicle, they have the balance sheet to support the transaction, and then we have to put the gap collateral and the other dynamics together. There also are a lot of moving parts here. We can change the dynamics of the policy. Do we blend, not blend? The way we format the loan payoff, the out-of-pocket, and the way it weaves together. So we have 4 people in our company that do nothing but generate these models all day long. We probably generate on average, I would say, 6,000 per year. Do we close that number of cases? No, we do not. The average case will go about through 10 to 12 different iterations in this modeling phase. We are used to that. It's typical because people have to be consulted on the dynamics of the transaction. Then, of course, they go through a Q&A phase, shaping the transaction differently, et cetera, et cetera. But that's what we do here. That's what we specialize in. So let's talk real quick. I already covered this for gap collateral on the big deals. Again, 100% secured at all times. Cash equivalents. We also can use the cash surrender value. But the life insurance policies, we do see a lot of whole life paper here that can be used supporting collateral, LLCs, et cetera, et cetera. This is the second most important part as far as the pre-underwriting phase of any transaction. First part, remember, loan structuring. Want to understand the loan structure. Want to understand how the loan is to be built out. That'll determine underwriting. The second thing I want to deal with right away is gap collateral. The worst thing any advisor can do on one of these big transactions is wait until the finish line or near the finish line to talk about gap collateral. I hear it every single day, though. The amount of nickels I have, if I got paid a nickel for every time you hear this one, don't worry about it. They got plenty of collateral. Nope. I'd like to be more specific in that, because I will tell you the number of transactions where you're like, oh yeah, they'll post cash, they'll post securities. We get near the finish line. Well, you know, they're really hesitant about sending the money or using their brokerage account. Do you work with raw land at all? So don't want to deal with that. That'll put a transaction dead stop. Now let's make a little pivot. Take all that information I just told you, keep that, retain it. We're still going to use it. So about 6 years ago, Northstar looked at the market space and we wanted to be able to provide a lending solution that is not reserved for their higher net worths. Also a transaction that minimized to the greatest extent we can the degree of risk of the financing transaction. We basically wanted to provide advisors like you a much broader swath of potential clientele, a larger number of people that you can serve. You're not going to have to go elephant hunting. You're not going to have to be chasing those career defining moments with the big cases. Although it's great, we're not going to get those all the time. So this is what we call the Insured Retirement Advantage IRA with a little bit of periods in between the letters. It's not meant to be an individual retirement account. It's the new Insured Retirement Advantage. And it is orientated towards a different client segment. So here we're talking about, relatively speaking, smaller cases. These are still good cases. I get caught out a lot, and I'm very careful about the way I use the word small in my industry. These are not small cases. These are fantastic cases. Just when I use the word small or small case platform, I'm talking about in the financing business. That's entirely the optics that I'm using. So the average death benefit we do in these transactions is $1 million to $4 million in face amount. We can go higher. Sky's the limit. We've done some deals here on this chassis that we're up to $40 million. But the average DB that we've done on these cases since its launch is $1.7 million face amount, 45-year-old, preferred risk, professional accountant, attorney, and also medical professional, lots of dentists and lots of doctors. Now, the premium, which is something that's going to be very important, and we're going to talk about that more, the minimum premium for a standalone case is $50,000. Now, I say standalone case, that'd be one case. We could have a couple, husband and wife, we could have partners, we could have a company or group situation where we can actually go below 50,000. But most of the time, we're dealing with one case, one insured, and the minimum premium is $50,000. Now, the out-of-pocket, remember the out-of-pocket we talked about on the large case platform, can be paid out or paid to the debt provider at a minimum of 5 years all the way out to 10 years. Maximum age is right around 60, 62 or so. Reason being is that when we start to get up in the mid 60s and closer to 70, when you finance cases, there's basically forces working against us, higher COIs, higher expenses and things like that. Why is that important? It hurts the accumulation phase of the policy. The interest rate currently on this loan is out of the first year interest rate is 2.63%. I won't drone on about that, but it is a very competitive interest rate for the size of this deployment. The other key understanding is all that information I talked about before on the loan structuring side, all those same degree of options are available here. So even though we're in the smaller premium levels, the individual entering the transaction is not limited to the way they want to structure the loan and the planning scenario they want to use. In fact, they have the same exact degree of options a larger case platform provides to them. Now, in our large case platform, most of our cases are done on a zero split basis, meaning our revenue is not based on a compensation split with the primary writing agent. We call it the zero split platform, hence that. Now, in this deal, though, our only revenue source is a nominal case split of 15%. So we do have to be on the app. Now, the key aspect of this from an illustrated basis, and I'm going to bring up another loan model that we can look at, but the biggest differential that I will point out is this transaction is engineered to manage risk to a greater extent than large case transactions. And it does so primarily by reducing leverage, and it does it with some other safety margins built in to the extent that we do not display the use of gap collateral. So when we compare these two loan models, that is the one thing that I'm going to focus on. And again, go back to my comments on leverage. So we are going to decrease leverage in this transaction and also decrease the level of risk with the transaction. Now, when we order the output, meaning when we get a request in, that case design team I talked to you about, they get a fact pattern in. You know, we get the demographics on the insured, we get basically what you're trying to solve for face amount, the planning situation, et cetera. So what they do is they generate the loan model, and we offer this as a consumer piece. Most of the information that we provide from a marketing standpoint is all financial services directed. But this is a commercial oriented piece, which you have the discretion if you want to use or not. We talk about financing in somewhat general terms. We talk about the dynamics of index universal life insurance, taxation benefits related to life insurance. We do an overview of financing, talk about the interplay between interest rates and the way that the crediting is going to work, hopefully on the policy over a period of time. We have a summary sheet that'll kind of go over some of the particulars that we're talking about today, some FAQs, and then we get to the loan model. So let's get on this here. So we'll go back to where we were. So here, still have a great case, over $100,000 premium case. Again, we're back to a 10-pay non-MEX solve. Now, the key thing we'll talk about here is, again, here's our leverage point. So remember, the out-of-pocket on that previous sample I showed you was $60,000. $60,000 for over $300,000 in premium. Here, 111.56. Right away, you should be able to identify this is a higher level of out-of-pocket as a ratio of premium, and this defines the leverage. So we have less leverage in this transaction. And then when we move over to this side of the scale, remember these columns before in my previous example were populated with all those numbers. Those numbers were approximating the amount of additional collateral the particular guarantor was going to have to post over a period of time to support the transaction. From an illustrative perspective, we are not showing gap collateral. Now, I do get this question, is this outcome guaranteed? Nope, it is not guaranteed. We have certainly built certain provisions in there, but I'll tell you the one thing that we sometimes cannot control is the behavior of the borrower or the individual in the transaction. This out-of-pocket is integral to the way this works. Absolutely vital. Why? Well, let's take a look at the way it works very briefly. So this out-of-pocket, as you see at this level, here's our scheduled interest. So note that the scheduled interest is always below the out-of-pocket. What we do with the differential between the interest due for this loan and the out-of-pocket supplied to support it is we apply it to the principal balance of the loan. So we're amortizing this loan balance over time. We are reducing the loan balance. And that is a critical understanding, because if we're to have a transaction which is at least hypothetically mapped out to be supported only by cash value, it's absolutely imperative to have the cash surrender value higher than the loan balance by some percentage. That percentage magically enough between 114 and 116%. So again, we have to have the policy CSV higher than the loan balance to bring forth this type of condition. Now, one aspect of this is that the products that we utilize must have the early cash surrender value rider. You may be familiar with these, but a number of index universal life insurance policies do offer some form of early cash surrender value rider. Basically, what they do is they will enhance the relative amount of policy cash value to the premium solve. Now, they are not going to cover the full spread. They're not going to cover the full spread, but they will enhance that cash value relative to, again, the premium solve. And again, the premium solve is the primary determinant of the loan balance. Now, those riders do come at a little bit of a cost. Generally speaking, the writing agent is going to be on a graduated commission scale over a period of time, and that's going to be modified as such. Also, by the way, they do come with some degree of policy drag. Now, I'll make a comment about the traditional deals, is that we have wide latitude on product formation, including the use of the riders. The riders are basically mandatory in this arrangement. The only exception would be a sufficient exchange coming into the policy would offset the impact of the rider. So when that does come forth, we can sometimes take the rider off. But again, we're going to have to model it. We're going to have to ensure that we have proper safety. Now let's talk a little bit about the handling of policy cash values. One of the most egregious mistakes, but that's also very common in my industry when I look at our smaller competitors and what they do, when they calculate collateral, they make the most common error there is. They cut and paste the end of year policy cash surrender values directly from the sales illustration. Now, for you, those in the industry, you should know that those values are completely hypothetical. They're also end of the year, and they assume the product behaved as illustrated. Completely hypothetical, unknown. And no lender, no debt provider in this industry in their right operational mind even looks at those illustrations for the sources of their gap collateral. We're going to be dealing with cash surrender value that's a known number. Now, we're also going to have to account for the policy cash surrender value varying over time. Back to the carrier illustrations. They show the pickup in all these variables on a very linear and very consistent basis. It just operates like a metronome. Just beautiful, consistent over time. It doesn't work like that. We're going to have periods of stress. We're going to have periods of time like we're going through right now with the broad market averages, where the policy CSV is going to essentially lay dormant. You're going to be relegated to guaranteed crediting in these products. That has a substantial impact on these transactions. And what we do on the big case is we modulate that. We vary the performance of the policy. We put underperformance into it. As far as this platform is concerned, we do exactly the same thing. In many instances, when we do these models, we assume the policy doesn't do anything for 5 years. On some of them, we assume that it doesn't do anything for 10 years. Why? Because we're trying to build a safety valve. We're trying to make a situation over time where this out-of-pocket component is going to be sufficient to cover the loan balance over time. Talk a little bit about the sales process. The sales process in the big case environment is really kind of an opportunistic situation. I won't go into it a lot, but another thing that I hear all the time, especially when I do seminars, is people raise their hand and say, hey, how can I sell more financing? I correct them and stop them right there. You are not selling financing. I don't even consider financing a strategy. It's an alternative funding mechanism. You have to build the building blocks. You have to create the foundation of the sale based on the merits of the product and the needs of that individual. You get those two bolted together and they're working well together. You got people nodding their heads. Then you understand dynamically when you enter financing. It's more complicated with the big cases. Now, this one, though, I think is a little bit more straightforward, because if, for example, take the example of that minimum premium solve of $50,000. The out-of-pocket that you'd expect for that transaction will be $25,000 for 5 to 10 years. Well, I tell advisors, you know, if you've got a permanent sale teed up, or maybe you've taken people through steps and you've educated them out of term, you've got them into UL chassis and permanent life insurance, and then you've moved them into the more advanced accumulation products like IUL, and they like that idea. And oh, by the way, they're willing to spend $25,000 out of pocket, let's say for 15 to 20 years. I think the pivot to something like this, an alternative funding mechanism, is a giveaway. I would do it each and every time. So to me, positioning this is much more straightforward. It's much more templated too than the large case environment. That's why we have a lot of several agencies and agents that are knocking 4 or 5 out of these a week or so. They basically have a drumbeat pattern. They build marketing programs around it. They know how to package it, and it can be packaged more so and more templated because you know how the transaction works. Again, a large case environment, lots of variables, lots of changes we can make. With these, basically what people do when they send us a request sometimes is they just say, hey, they can spend $40,000 a year. That tells our case designers, we're going to run an $80,000 10-page non-MEX-solve. Do you want income, or do you want DB, or you want both? And how long are they out of pocket? And then we just go from there. So I think I've already almost blown through my time quotient, so I can stop there. We can cover questions.
Yeah, Dale, under the IRA program that you have, is there still a $5 million net worth? I see that you have emerging affluent positions and so on. And this is also resulting in strategies that will result in the ability to pull tax-free income out from this, right? It's part of the supplemental retirement planning process that you have.
Thank you for that. Yeah, that's the one thing I spend on the larger presentation. I spend a little bit more time on the genesis of this transaction. And one of the key things that we had to do is work with the participating carriers. That is, not all carriers are supportive of this loan regime. The traditional landscape is fairly wide open. But when we went to the carriers and we said, hey, we want to be able to work with a different client segment. And oh, by the way, they're not going to have a $5 million net worth. In fact, they may have $1 million net worth. They're still well-to-do. I mean, we're not saying they're poor by any means, but they're certainly different than your average high net worth client entering financing. So that's why some carriers have said, nah, we're not completely comfortable with that. But we've got 6 carriers that said, yes, I mean, we will vet these cases on the premises that they've got sufficient income. So again, in the longer presentation, I spend more time on this, but the focus from an underwriting perspective for the Insured Retirement Advantage is different than the large case format. As I indicated to you, the large case format is very balance sheet driven. We're concerned about the net worth. We're concerned about gap collateral. We're concerned about the future and the ability to secure the loan. With this, we're much more focused on income, because generally speaking, this is like Dan, you said, the emerging affluent. Doctors and things like that, they've got terrific income. I think the average income that we do on this deal is like $350,000 a year. But for a variety of reasons, they haven't built their balance sheet out. We see a lot of physicians with lots of debt, et cetera. So they don't have the net worth to move them into that tier, but they do have the income to support this transaction. Back to my prior point, the out-of-pocket is the engine. That is the whole thing that drives this thing going forward, and that's why we're focused on that. So the carriers that have vetted this and they approved it do put it under the bucket of their emerging affluent market space.
Excellent. Great. And I think the way you teed it up with, if you've got a client that's thinking about a LERP type of strategy, or that tax-free retirement income advantage from a life insurance contract, and they're looking at putting $25,000, $30,000, why not talk to them about a fairly conservative leveraged solution that can result in higher numbers for them. Great share there. We're entering a little bit of unstable times, a lot of inflation pressure. How is that affecting your lenders, and what's your prediction, or what are you seeing going forward here in the financing space?
We have not seen the let's say potential changes, of course, which has been well broadcast. I mean, the monetary policy is going to get less accommodated in this country, worldwide, in fact. And so we've just for this week, for the first time, have started to see reflection in base rates. And what I mean by base rate is the interest rates in this industry segment are comprised of 2 pieces. It's a base rate or benchmark rate, and it's a spread. The benchmark rate has historically been for many years LIBOR, or the London Interbank Offer Rate. For you, the folks who have been watching the press and aware of the situation, LIBOR is basically a subjective mechanism. It was not objectively set based on any kind of credit market conditions. It was fixed, basically, is what the regulators and also people that brought it. Basically, there's still a guy in prison over this. So there's been an entire movement globally to move off of LIBOR as a reference. And we have already seen that happening in our industry. In fact, we do not have any lenders right now that we use that are using LIBOR as a reference any longer. They're using a combination perhaps of prime with a negative spread, CMT, which is the Constant Maturity Treasury Index, or perhaps SOFR, which all you probably have also read about as well. But we have seen pressure on rates already, especially on the fixed side. I priced a loan out 2 weeks ago. It was a $500,000 premium sell. They wanted a fixed rate, came in at 3.35% for 5 years. It got repriced just this morning at 3.9%. Now, fixed is different than variable because it has to have hedging and other derivatives involved, but we are definitely seeing rate pressure. And it's an important consideration because, of course, these transactions ultimately over time are highly dependent on the relative spread between the loan interest charge, which is going to impact the loan balance, and the crediting on the policy. It's kind of that arbitrage that we're seeking. We'd like to have a delta somewhere in the neighborhood of 2.5 to 2.7% over time in the transaction. When that closes up, it certainly changes the dynamics of the way these things operate. And we have to be attentive to that. Now, you folks that are aware of IUL and the way it's built, it's dependent on risk-free rates. So in theory, when interest rates start to go up, these products should be able to do some upward adjustments on caps and some other things like that, although the lag is usually sometimes up to 18 months. So, Dan, I mean, I can go on about this, obviously, but we're being very attentive. Yeah, we're
very
watching
attentive.
it.
You're seeing it for sure. Yeah.
Mm-hmm.
And then you also mentioned the policy performance and being with a solid carrier and one with a good rate history and cap situation as well. So.
Yeah, and the other thing too, at least in the big case size, when people get nervous about it, I say, well, depending on your cash flow, increase your out-of-pocket, decrease the amount of leverage you're taking on. That'll help insulate you to some extent. The IRA is kind of built out already. So, one of the things you can do with the Insured Retirement Advantage chassis is don't do a 5-pay minimum out-of-pocket. Do a 6-pay, 7-pay, 8-pay, something like that, because that'll help control that loan balance to a greater extent.
Well, great. Really appreciate your time, Dale. Our team really enjoyed working with your team at Northstar, and any advisor that is out there, you reach out to myself, Brendan, Steve Berge, any of our RVPs. We can all assist you with taking a look if this is right for a client or to discuss it further. And Dale is a fantastic resource, and we really appreciate you being here. If there's any questions, we open the line. Just mute yourself or unmute yourself and ask, or I didn't see any in the chat box other than questions.
Hey, Dan, I have a question for Dale.
Sure.
It's Chase.
Hey, Chase.
Dale, could you speak to a little bit more of term blends? Are most of these strategies inclusive of, or what percentage of these cases are incorporating term blends?
We do not just blend to blend. I mean, it actually is. It makes the designer's life easier because it decreases the relative cost of supporting a death benefit and increases accumulated value. So actually, from a case designer's perspective, it's nice to blend, but obviously we have to be attentive to our distribution sources and its impact on target. So we, generally speaking, will only blend if we have to tactically for a specific reason. Perhaps we have a underwriting risk that we have to offset. Definitely, once you start getting over age 55, we highly recommend some degree of blending. And then also, we have some altruistic advisors too that just blend out of the gate, especially on income solves.
Sure. It obviously it helps early cash value for collateral. Is that one of the considerations that you would say is important?
I'd say it's a long-term impact.
Long-term.
Yeah, definitely. Mm-hmm.
Okay.
Yep. And then, we only max blend sometimes. I tell our designers always max blend when agents are writing their own policies. And then sometimes you still get questions about that. I won't go into the humor.
Yeah, please know it's not driven by target or, comp. I just seeking to understand.
Yep. Understood. Yeah. Sometimes we just dynamically have to do it, especially on death benefit solves for older people, et cetera.
Gotcha. Thank you.
Okay. Thanks for the question, Chase. Good to hear your voice. Any other questions? All right, now for our giveaway. Dale, I'm going to ask you to pick a number between 1 and 25.
21.
21. Okay, who's the winner? Who's the winner? Devesh Sharma is today's winner. Devesh will be in touch with you. Thank you for attending today, and you'll be receiving a Starbucks gift card and some free CE. And
no banana bread?
No banana bread, but you
Oh,
know,
well.
let those
Okay.
bananas get a little brown, right? A little more flavor. So, Dale, really appreciate it. Turn in next week for our brew. We'll have E4's very own Bill Anderson, a wealth strategist, discussing E4IS non-qualified annuity maximization analysis. So annuity max next week for those clients sitting on large IRA balances or annuity balances. So thanks, friends. Have a fantastic day. Thanks for joining us on the brew.